Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Well, I have to tell you, it's been a tough stretch in bondland. Investors are struggling to dimension the disruption in the Middle East, and the worst-case scenario, escalation, and a Fed turning even more hawkish, has brought a stagflationary scenario back onto the radar. On top of that is a bit of capitulation on the part of those who believe in a short resolution. Washing out those crowded positions is only adding to the sense of dread. This too, in our opinion, shall pass. This week, our three things are: 1. Shock risk. Risk is rising, but will credit reprice? 2. Loan growth surge. Where did that come from? And 3. Earnings relief. Good news is on the horizon. All right, let's dig a bit deeper. Shock risk. We've talked over the past several months a lot about the range of risks facing investors: inflation, credit blowups, AI effects, and of course, geopolitical developments, and how any one of those could rise to a level that could materially impact credit performance. Well, here we are, and those risks, those shocks, have risen to varying degrees. The key part of that comment is to varying degrees. We thought it would be useful to walk through these shocks and evaluate just how disruptive each one of these could be. All right, let's start with the geopolitical development, events in the Middle East. The first thing we think of is that markets historically have not moved all that much on geopolitical developments unless they materially impact economics, such as supply and demand of a commodity or trade flows. In this case, that's been the case as the price of energy has spiked, as has fertilizer and helium, which is used in a variety of high-value-add manufacturing. We talked last week about how increased energy efficiency makes the developed world less impacted by a spike in energy prices. We cited the example of oil, how the price today would have to hit $190 a barrel to have the same impact that $100 a barrel oil had back in 2011. Ultimately, how long elevated energy prices persist means more than the magnitude of a spike. In the U.S., both businesses and consumers in the aggregate are well positioned to weather elevated energy prices. Businesses are enjoying historically high margins, while consumers are due to receive larger than expected tax refunds. In Europe and in Asia, which are far more reliant on Gulf energy and fertilizer, the impact hits disproportionately. Now, it goes without saying that there is a range of outcomes in this situation, but for what we can see today, the shock does not justify a material repricing of credit risk. The Middle East shock, of course, is spilling over into the inflation story. Higher energy and food prices, remember fertilizer, reduce purchasing power and keep central banks on hold. That comes on top of any tariff headwind passed along to end consumers and businesses. Higher inflation, of course, devalues risk assets. The good news is that rates remain well within a constructive range, judging by historic averages, and any growth slowdown will bring back the prospect of rate cuts. On the AI front, the news is more mixed. On the positive side, there seems to be no letup in the massive capex deployed to build out AI's infrastructure. And we are beginning to get a picture of how value creation is taking place. That continues to underpin elevated equity prices and the wealth effect that goes with it. The downside is that we have been reminded that AI is also a disruptor, leaning on vulnerable sectors such as software, as well as limiting job creation. But for now, the overall impact of AI on credit tilts to the positive. And finally, credit blowups. There continues to be an anecdotal flow, like MFS, the UK mortgage lender, and Infinite Commerce, the Amazon aggregator roll-up, but nothing that points to contagion. However, we would be remiss to not mention software, a sector whose AI vulnerability has been responsible in part for private credit redemptions, along with compressing returns in the asset class. We remind that default probabilities will develop over time, and related severities are likely to fall into a fairly broad range, and not every software firm will be negatively impacted by AI. Overall, the shocks taken together have not been all that material to credit, which of course has been bid to very aggressive levels. The widening we've seen in spreads feels more like a correction than a repricing of risk. All right, on to our second thing, loan growth surge. Well, this was a surprise. In the Fed's latest release of its H8 report, that's assets and liabilities of commercial banks in the United States for the uninitiated, commercial industrial loans in the banking sector jumped 22% month on month annualized in February. Well, that's the highest growth rate since 2021. Total loan growth was 11% as consumer loans grew 4%, while real estate loans, both residential and commercial, grew 3%. But that C&I growth surge caught our eye. What do we make of it? Well, for starters, it represents, in our opinion, demand strength rather than an easing in lending standards, judging by the latest senior loan officer opinion survey from the Federal Reserve compiled back in December. In that report, the surveyed banks reported a modest net tightening of lending standards to C&I borrowers, despite stronger demand from large and middle market firms. Now, that outcome was to be expected, in our opinion, as lenders went back in and thoroughly scrubbed loan portfolios and loan underwriting standards and practices in the wake of credit cockroaches that presented in 2025's second half. Now, it is noteworthy that the loan surge took place before conflict broke out in the Middle East February 28th. Recall that in January and February, optimism in the U.S. had risen on the back of better-than-expected economic activity and surveys. For instance, the consensus GDP forecast compiled by Bloomberg for full year 2026 jumped in those months from 2% to 2.5%, with more than a few forecasters throwing out estimates of 3 to 4%. And we attribute much of that optimism to diminished uncertainty with regard to trade policy and the path of interest rates. In addition, we, and plenty of others, saw a broadening of economic prosperity as less restrictive interest rates, a productivity surge, deregulation, and upcoming fiscal stimulus were set to fuel above potential economic growth. While we would be surprised to see in March anything near February's loan growth rate given the uncertainty introduced by events in the Middle East, we do believe talk of stagflation or worse is inconsistent with the strength we see in the economy. Should that shock persist for 6 months or more, with oil at some level closer to $150 a barrel or more, yes, such a scenario could materially dent economic growth. We just don't see that as a base case. For what we can see, we see February's loan growth as a positive sign of the U.S. economy's resilience and vitality, and that's good for credit. All right, on to our third thing, earnings relief. Well, we got a chuckle out of one head of U.S. equity trading this week, who, in response to his interviewers ticking off of one headwind after another, said, with more than a hint of exasperation, "There's just not a lot of good news out there." Well, turns out there is, or at least we expect there will be. U.S. earnings season is upon us, blessedly so for those tiring of watching the price of Brent crude 24/7, listening to excitable types warn about systemic risks, or contemplating a litany of headwinds. Q1 earnings for the S&P 500 is expected to come in at 12.5% above the year-ago quarter, according to FactSet, which would mark the 11th consecutive quarter of earnings growth and the 5th of the past 6 quarters where growth would hit double-digit levels. 8 of the index's 11 sectors are expected to report year-over-year earnings gains. Revenues are expected to grow 9.6% year-over-year in the quarter, the highest growth rate since the third quarter of 2022. All 11 sectors are expected to post revenue gains. Sector analysis cools the story a bit. Information technology, no great surprise, continues to lead the way, with earnings expected to soar 45% in Q1. Surprisingly, materials, led by metals and mining, is also a star to the upside, with earnings expected to grow 24%. Financials are also in the double-digit category, up 13%, led by insurance and consumer finance, both benefiting from pricing power. In addition, capital markets results figure to be strong on the back of elevated volatility. But beyond those standouts, results are forecast to be less robust. Industrials, consumer staples, and discretionary are all around 2% growers. Communication services and healthcare are expected to fall 3% and 9% respectively. All of this, of course, is backward-looking, which means management color around the litany of headwinds and their impact on future results will be what drive investor reaction. And on that front, we would expect the usual, "Well, we're cautiously watching global events and are prepared to adjust" statements. But that's not a warning. And for what it's worth, over the next 3 quarters, analysts are expecting earnings to grow, are you ready for this? 18%, 19%, and 18% respectively, bringing the full year growth rate to an exuberant 16%. Now, we might take the under on all of those estimates, but the underlying forces driving growth, including wealth effects, the tech capex supercycle, security of everything, and industrial renaissance, should continue to produce much welcomed good news. So there you have it. 3 things in credit. 1, shock risk. Risk is rising, but we don't see a material repricing of credit. And 2, loan growth surge, economic fuel that counters all the doom and gloom. And 3, earnings relief, a reminder that the underpinning to the U.S. economy remains solid. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.